Good morning and welcome to the Open here on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. U.S. President Donald Trump has pushed back a tariff increase on some imported goods. It is for a year. The move will delay a 30% tariff on upholstered furniture and a 50% levy on kitchen cabinets and vanities. Trump says the move is due to ongoing trade talks. The 25% tariff imposed in September will remain. Well, Denison Mines is ready to begin building its uranium mine in Saskatchewan. The Canadian uranium company says as soon as it receives final government approvals, it will be poised to begin producing uranium at the site by mid-2028. The project is set to become Canada's first major new uranium mine since Cigar Lake. Denison warns, however, the total costs for the project are now estimated at about 20% more than previous, at $500 million. That's due to inflation and increases in expenses. Shares of Sable Offshore are surging in pre-market trading, up 19% right now after it got the green light to restart a controversial pipeline. Sable can now begin pumping oil from its 3 platforms off the coast of Santa Barbara, California, after a federal court ruled in against environmental groups. It's the latest win for the oil operation, which has been battered by lawsuits and regulatory scrutiny since ExxonMobil handed over the reins 10 years after the unit was shut down following a massive oil spill. And taking a look at the futures right now, looks like we're getting a mini Santa Claus rally, maybe for the last 2 days of it. After a struggle to end 2025, 2026 is looking good to start. You see the Dow up by 0.33, NASDAQ 0.9293, and the S&P 500 up by a half. And moving over to the TSX, it was another struggle. It ended the year down for the day, but up, of course, for the year, almost 29%. But that was a real fizzle to end the year. It had topped 31,800, all 32,000 at one point, but now it's back down, 31,712. Struggling. We'll see how it goes today. And moving over to oil. And you can see WTI off by 0.96%. And over the last year, it was a rough year for it, down by 20.7%. The metals now, and another up year. It's up into record territory. You're closing in on it. Just still below 4,400, but up by 0.93% for gold. Silver having another roller coaster. It's up, but it's been all over the place. It's in the 70s right now. But gold, you can see, is up for the year 65.87 as we start 2026. And the dollar, new year, bit of a slow start to it, down by almost 0.2%. Over the last year, it's up by 4.7, I should say, excuse me. And let's take a look at Bitcoin, which had a roller coaster 2025. It closed the year off by almost 6%, 5.78% after seeing peaks above 120, but now down below 90,000, almost below 89,000 is where we're sitting right now with Bitcoin. All right, time to look ahead to see what we can expect for the U.S. and Canadian markets for 2026. Our next guest thinks Canada will see some developments in its economy, especially with new collaborations with Asian and Middle Eastern countries, thanks to the Carney government. Here to talk about this is predictions for the market, Michael Dayhall, Senior Portfolio Manager at Dayhall Investment Partners, Raymond James. Michael, thanks for joining us. Happy New Year to you.
Happy New Year as well, Roger. Good morning.
All right, we want to talk about both big pictures, U.S. economy, Canadian, but let's touch on Canadian first. Your thoughts? You think there could be some good signs, good times ahead?
Yeah, absolutely. We do think that the Carney government, some of the policies that they're putting into place, could provide some tailwinds to our Canadian economy and to our Canadian equity market. Areas that we do like are industrials, as well as other types of financials sectors within the Canadian economy. But we do think that the Carney government will have some great policies in place, more of the physical side. The heavy lifting has been done by the Bank of Canada, so we do not expect any changes to interest rates in 2026 in terms of rate cuts. But we do think that now the physical policy should do its job.
And start to kick in. What else would you like to see from the Carney government?
Continued spending, more spending on infrastructure, on construction, to really beef up our economy here in Canada, as well as trade partnerships outside of the U.S. I know Carney has been going to other parts of the world, Middle East, Europe, Asia, to strengthen those relationships. So what I'd like to see in 2026 and beyond are more partnerships with other countries outside of the U.S. and really strengthen those relationships and helping our exports go across borders.
Now, I think a lot of people were expecting these magical deals to be signed all in the first 3 months after he made these announcements that we're looking outside the U.S. What kind of possible headwinds might we see for the Canadian economy?
The big headwind is obviously the U.S.-Canadian trade relationship, right? We do have the USMCA agreement coming due, I believe it's August of 2026. So we could see some volatility ahead of those talks. And if anything, if there is any agreements prior to that date, but that could be a headwind. Another headwind to our Canadian economy could be a job market. We are seeing, a bit fragility in our job market, although the last 3 months, the unemployment rate has come down slightly better than expected, primarily due to part-time jobs. But the job market is something that we are looking at, whether unemployment rate goes higher and the impact on immigration. Obviously, the government has reduced the number of immigrants to Canada, and that could have an impact to our economy as well.
And it does seem like a lot of companies have adjusted or adapted to the tariffs, and they didn't have as much of an impact. But of course, if Kuzma goes by the wayside, as Trump has hinted that could happen, that would have a huge impact, though, wouldn't it?
Absolutely. And that's the big the question mark is the uncertainty around the trade talks, right? So if that does go a bit sour, that could have a headwind to our economy, and so that's something that we are definitely looking out for. But we do think that our government, Carney, and the party will have our best interest for the Canadian consumers to kind of alleviate any negative impacts to those discussions or to that agreement that could come forth.
Okay, let's talk a little bit about the U.S. economy. What are you seeing? Unemployment was down there as well. It seems to have defied expectations, hasn't it?
Absolutely. We had such a resilient U.S. economy in 2025. After the Liberation Day of April, many people thought that the U.S. economy was going to go and, derail. And however, the consumer, the U.S. consumer, once again proved resilient. And GDP growth in the U.S., I believe, will probably come for the full year higher than expected. And we do think that continues. We think that the U.S. resiliency continues in 2026. This year, we'll probably see more tailwinds on the AI front. We're looking at companies that are benefiting from AI, from productivity, from efficiencies on adopting AI. So we do think that, in 26, U.S. economy continues to march higher, obviously at a slower pace for the last 2 years. But we do think that we will probably get another robust year in the U.S. Economy, and we'll probably get another good year in the U.S. markets. We'll probably get more volatility this year than we had last year, but with some of the, the tax cuts that the Trump administration is implementing, deregulation, as well as the Fed continues to ease throughout the year in 2026, that can all provide very fruitful for the U.S. stock market.
And you mentioned about AI, and companies are starting to incorporate it now. Are we starting to see actual figures on savings and or potential savings with it?
Yeah, we're still in early days. A lot of CFOs, CEOs on the earnings reports, they are earning calls, sorry, are looking at AI, how they're adopting it, how they're increasing their margins, improving their gross margins using AI. So we are still early days of AI adoption for the beneficiaries, but we do think over the next several quarters, it will get better as more and more companies adopt AI in terms of improving efficiencies. And again, that would go right to the bottom line, improving gross margins, which in turn helps stock prices.
Okay, I just want to bring it back to Canada for a sec. Mortgages for 2026. It's always something everybody's talking about. The housing industry, the housing market for Canadians is a big deal. What are you seeing there?
So that is a potential headwind. We do have a number of mortgages that are renewing in 2026. Remember, these are the so-called COVID mortgages that people got 5 years ago, right? So that would be something that we are looking at during the last the big Canadian bank earnings season that we had last month. Banks are increasing their PCLs, putting some money aside for potential loan loss provisions if consumers are unable to renew their mortgages or have difficulties with their mortgages with a higher rate. But that's something that we are definitely looking at. It is a topic of concern in 2026, the housing market.
Okay, we have to wrap it up there, Michael, but thank you as always for joining us. All the best for 2026. That's Michael Dayhall, Senior Portfolio Manager at Dayhall Investment Partners at Raymond James. Coming up, we'll look at the year in interprovincial relations in Canada, including the renewal of old rivalries. That's next. Well, it was a year, 2025, that many in our country were united by a common goal to stand up for Canada. That includes the premiers of the provinces and territories. They came into focus in 2025 as the front line of the trade fight. But as CTV's Andrew Johnson shows us, old interprovincial rivalries were also renewed.
In a year that started out looking like this.
I think Canada is going to be a very serious contender to be our 51st state.
We're going to put very serious tariffs on Mexico and Canada.
Canada's premiers, the faces of each province, became a focal point of resistance against Donald Trump's trade threats.
As Canadians, we need to realize that he is not joking.
Each standing up to defend their provincial and territorial economic engines on behalf of Team Canada. An early move, all but two, opting to remove U.S. liquor from store shelves. Manitoba's Wab Kinew took a page right out of the American president's playbook.
It's a wonderful order. It's a beautiful order. This order is pulling American booze off the liquor mart shelves.
At the White House in February, the premiers met with members of the Trump administration, presenting a united front.
The worst thing we could do as a country is not show up.
For Ontario's Doug Ford, showing up meant going on the offensive, threatening to punish America by any means possible, including restricting power sales.
If the United States escalates, I will not hesitate to shut the electricity off completely.
Ford even urged Alberta to put an export tax on oil.
Their gas prices go up $90 to $1 a gallon. They will lose their minds.
That did not sit well with Premier Danielle Smith, who called the idea absurd and self-destructive.
You can ask me as much as you like. The answer is no.
Smith, who'd been criticized for visiting Trump at his Mar-a-Lago home in January, said diplomacy, not retaliation, was the best way to deal with the president. The Team Canada narrative was also interrupted in May, when supporters of Alberta separation celebrated a Smith government bill that would make it easier for voters to force a referendum. Smith said she didn't support separation, but also wouldn't stand in the way.
I will respect the outcome of citizen-initiated referenda, and that's why it's my job to make sure it doesn't get to that point.
I want to welcome everyone.
By summer, 6 months into the trade war, premiers and territorial leaders were in Ontario cottage country, talking trade, tariffs, and teamwork.
Right now, our economy in all Canada suffers because of the uncertainty.
Another goal of the three-day summit was to make it easier to move goods between provinces at a time when many discovered buying Canadian could be difficult.
I can't say how many times I've heard it's easier for me to access Alabama than Alberta.
In late September, Trump again turned up the heat, announcing new tariffs. Ontario's response got under the president's skin.
When someone says, let's impose tariffs on foreign...
A $75 million ad campaign airing on major American networks starring former President Ronald Reagan.
Over the long run, such trade barriers hurt every American worker and consumer.
Trump called the ad fake and promptly ended Canadian trade talks.
They did a crooked ad. They know it was Ronald Reagan loved tariffs.
Ontario ended up pulling the campaign early, but the man who authorized it was downright Trump-like in declaring its success.
It was the most successful ad in the history of North America.
It was around this time cracks in the Premier's Team Canada collective widened out west over Alberta's pitch for a new pipeline to send bitumen to BC's northwest coast. Despite a hard no from BC's David Eby, Danielle Smith pushed to have the proposal added to Mark Carney's major projects list.
Premier Eby's comments are un-Canadian and they're unconstitutional. All it takes is the Prime Minister to say yes.
It's not the Danielle Smith show, it's the Canadian team. And we all deserve the same opportunity for the same federal funding for our projects as she does for hers. That's not un-Canadian, that is fair.
Smith got what she wanted, a memorandum of understanding signed by the PM.
I think it's going to unleash an incredible amount of investment.
As 2025 comes to a close, with Canada and the U.S. still deadlocked on a trade deal, we can expect a continued focus going forward on the premiers, advocating for their provinces and territories, and trying to get along. Andrew Johnson, CTV News, Vancouver.
And coming up, John Zechner's outlook for markets in 2026. That's next. Well, it's a brand new year, which means brand new possibilities for the markets, especially around interest rates. I spoke with John Zechner, chair and founder of J. Zechner Associates, about it.
Rates are becoming, I think, a tougher call. It's really a sort of a ball up in the air right now. It could go both ways, and I've been more inclined to sort of think we'd be hitting lower rates because we'd get some more economic weakness from the tariffs and other things. And we're not really seeing that. We're seeing a very resilient North American economy in general. I mean, Canada, because the trade agreements didn't, the tariffs didn't hurt us as much because things that were sort of compliant under USMCA it didn't apply to. So we've sort of come out of that. And in the U.S., you know, the markets held up better. The consumers held up somewhat better, only at the high end. And obviously the AI spending has kept, the economy strong. And on top of that, you know, it's sort of pedal to the metal with fiscal policy in both countries. And that's sort of, you know, offsetting any sort of any potential weakness out there. I mean, you look at it. I mean, it's the last three administrations in the U.S., quite honestly. The first Trump and then Biden, now Trump too, that they've, you know, in peacetime, you know, in non-recessionary times, you're running deficits of 6 to 7% GDP, which is unheard of. So you put all that together and I think, okay, you sort of got a more resilient economy. You got inflation sticky in this, you know, 3% range. I mean, that last number is a bit of an anomaly and we're still getting, you know, data because of the data restrictions flowing in. But, you know, inflation really isn't breaking down to the levels where you should get more cuts in interest rates. Okay. And, you know, no matter what Donald Trump may try to do with the Federal Reserve Board, you know, I don't know that, you know, he can sort of force them all across the board to get the 6 votes necessary to, you know, push down rates as much as he necessarily wants to. So in the end, what I'm saying is, you know what, rates may not go in a lot of places right now, and they may not achieve the results. They may stay relatively high because of resilient economy, sticky inflation, and you know, and effectively the yield curve structure in the U.S. and the term premium to attract all this deficit financing.
So what does that mean? I mean, I've seen that they're talking. The guess is 2 rate cuts for the year, and they probably factored that in for the markets right now. What happens if we don't get those rate cuts? How do you see the markets responding?
Well, funny, Roger. I mean, markets nothing seems to disrupt markets to any large degree. You seem to have this, you know, buying momentum that just continues on because, you know, the rate cuts didn't really come in as much as expected in the past year, in fact. But, you know, I think at a point, given the high valuations, it's a bit of a risk. But on the other side, if the economy continues to tick along as it is, you know, if you don't get any breakdown there, the fact that you're not cutting rates may not matter as much because it means the earnings will still be relatively resilient resilient and in line. And, but it'll just maybe shift away from some of the interest sensitive sectors, utilities to a degree that have done well, and even gold, and to more, cyclicals. The industrials may keep going, the financials in this environment where you've got higher longer term rates and maybe lower short term rates have done better. So you might see more of that, just moving to the real economy, not just tech and not just interest sensitives.
I know, but then today you look at tech and we see tech up, some of them are up 2 and 3% right now.
Well, they're having a nice bounce because they had we got no Santa Claus rally effectively in December, and so they stumbled a little into the year. And tech's had a bit of a tougher run lately compared to what they've had for the last, since the bottom in 2022. So, there's that aspect. But yeah, I would not bet against technology. Certainly at this point, it's an increasing part of the overall economy, and that's not going to slow down, particularly on AI. But I think it's just, where the valuations are extended, there's a little bit more risk. So we're careful where we're picking our spots there. And just the index weight in the U.S. and, the passive money flows, that worries me a little bit too. But, in the end, like I say, it's a tougher call because the resilience of the economy and the stickiness of inflation may disappoint some investors in terms of what they get on cuts. And certainly the expectation for, the housing market and others are for more interest rate cuts, and they're not going to get it. In fact, housing is a tougher call. I mean, problem is, even if you cut short-term rates, long-term rates aren't dropping, and long-term rates are what determine mortgage rates. So housing doesn't get the lift, and that's that's what the housing stocks are telling you. That's what lumber is telling you. That's what sort of Home Depot is telling you in their fourth quarter.
And just touching on, you mentioned inflation, 2.7. So there was some data that was missing from that. What do you think is realistic for inflation, and what kind of a role will it play?
I think core inflation is still running around the 3% level, Roger, both, particularly in the U.S. where, it's more important to see, what we're seeing right now in terms of the interest rate moves and then the central bank moves. Because you're right. I mean, there was you took out a core part of the housing index, or the imputed rentals factor, and they assumed it was zero. And they can't assume that's zero. And that's what you got to that 2.7 number. So, we're going to have a lot of revisions for these numbers over the next couple of months, but like I say, it's an odd one. The employment number is an odd one, and no one's really hiring. I mean, you're not adding to the employment levels, but because of lower migration levels and everything, or immigration levels in the U.S., there's not a lot of firing as well because people are a little worried about labor supply. So, it's a lot of things that may in that environment, and that's what some of the Federal Reserve Board members are telling you. It's better just to sit tight and watch and to see how it unfolds.
That was John Zechner, chair and founder of J. Zechner Associates. Coming up next, the opening bells. All right. Time now for the opening bells at the NASDAQ. We see Novabridge Biosciences ringing the bell there, and it is the first time they've rung the bell. They joined the biotech index at the NASDAQ earlier in December, about midway through December. They're ringing the opening bell. At the New York Stock Exchange, it welcomes executives and guests of Robinhood. It's an anti-poverty organization, and they are ringing the bell there. Time now for the first 15, easy for me to say. Okay, this is BNN Bloomberg. Trading is just getting underway. Let's check in on the equity market, see what's unfolding as we start 2026. Hopefully an improvement on how 2025 finished. Taking a look at the North American markets right now. Nice to see that. All in the green as we look. Tech stocks fueling a lot of that south of the border. And the TSX, we'll have to take a look and see what's happening there. But right now, it's up a half point roughly to start 2026. The S&P 500 up 0.6, and there's the NASDAQ up by more than 1 percentage point. And let's see who some of the movers are, what's shaking down there. And you can see on the TSX, we'll take a look, some names that we want to look at right now. And right now, the TSX up 28% for 1 year. That's how it finished. It was a good year. Denison Mines is what we want to talk about right now. There's a few that we want to get into, but this one Denison is going to start building its uranium mine in Saskatchewan. The Canadian Uranium Company says as soon as it gets final approval from the government, it will. They are expected in the first quarter. It will start to begin producing uranium at the site by mid-2028. So first mine in Canada in a while. And Capstone Copper, it's having some issues at one of its mines in Chile. One of the 4 unions there is on a strike. And it went today. They said they are ready to negotiate with them. But right now, the company, Union number 2 is what they're called. They are on strike. Now, the company says they expect to continue operations, but running at about 30% of normal production. Of course, copper at record highs. And Algoma Steel, taking a look at that, and you can see it's up 1.42% right now, is initiated with a hold recommendation at Jefferies. The analyst notes that the tariff overhang outweighs benefits from the steel producer's ongoing business transformation, and it has struggled in the past year as well. And taking a look at some of the stocks down in the U.S. that are moving and shaking right now, Wayfair and Renovation Hardware, they are both advancing. Take a look at Wayfair. It is up more than 7.5%. And that's all on the news that U.S. President Donald Trump has delayed tariff increases for a year for upholstered furniture, kitchen cabinets, and vanities. And can we, do we have RH? See how they're doing? We don't. Okay, no RH right now, but imagine they're probably seeing a similar gain right now. But Wayfair up now more than 8% on that news. Sable Offshore, another one to watch right now down south of the border. And it's expected they will start to surge with the news. It got the green light to restart a controversial pipeline. Sable can now begin pumping oil from its 3 platforms off the coast of Santa Barbara, California, after a federal court ruled against environmental groups who had been fighting that. And coming up, we'll explore the major technology stories of 2025 and how they're shaping predictions for 2026. That's next. "2025 reshaped how we think about the internet, artificial intelligence, and who really controls the digital economy." To unpack the biggest tech stories of the year and what they mean for 2026, we were joined by technology analyst Carmi Levy.
I mean, ever since OpenAI released ChatGPT 3 years ago, we've been saying the same thing. But this was the year that we stopped experimenting with it, and it really became a mainstream force. It started appearing in all of the services and apps that we use day to day, and companies started recognizing the potential here, started incorporating it into the way they work. But we also saw the downsides of it. We saw OpenAI being sued over suicides of teenagers, no less than 7 such lawsuits working their way through the courts now, kind of casting a shadow, not only on this one company, but the entire industry as OpenAI prepares for a possible IPO next year, as the industry continues to throw huge amounts of money at building out infrastructure to give them the compute capacity to deliver to that potential. So, this was a year of good news for AI, but it was also a year of, we've got to watch where we're headed with this. There's a risk here, and we have to account for those risks when we make those investments. Otherwise, we're never going to see the returns that are being promised.
I think that's what's so concerning sometimes about AI, right? When you look at how it's being used, particularly in social media, like as we head into 2026, there's still no real regulations around it. And I know we've been speaking about that for most of 2025, that federal governments need to kind of ramp up regulations. Do you feel like we're heading in the right direction when it comes to regulating AI?
We are, but slowly. I mean, we started this year, right at the beginning of January, there was the AI and Data Act in the pipeline to become a law. And then, of course, as soon as the federal election was called, it got killed, and it has not been reintroduced since. So that we end the year with that huge disappointment. We need to close the legislation gap here and ensure that we have a proper framework for laws that control or mitigate the most egregious risks of AI adoption, and also give the industry, give academia, give startups the resources that they need to capitalize on it. So let's start with that new law in 2026. We do have a new AI and digital innovation ministry. Evan Solomon is the minister. He spent most of the year having really great conversations with the right stakeholders and starting to move things in the right direction. We ended the year with some announcements on significant investments in quantum computing, which is the other part of the AI story. So Canada's starting to do the things that it needs to do, but AI is a very fast-moving, thing. And other countries are doing it better, faster, more efficiently, pulling those stakeholders together more effectively. So we don't want to lose pace here. We've got to catch up in the year to come.
When you talk about other countries, because I did want to bring that up, Canada compared to other countries in terms of this, Australia had a social media ban for kids that was meant to protect mental health. I'm not sure if that's maybe something that you're referring to as another country that's kind of on the right track. But did that kind of expose just how unprepared social media and social media companies are when it comes to protecting kids online?
It certainly did. I mean, you know, we've been seeing the research pile up for years that it does have a corrosive, toxic impact on all users, particularly young ones. But Australia was the first country to actually take that first step of banning it for an entire group across the country, and the entire world is watching. Now France is weighing in with legislation of its own, and a number of other countries can be expected to introduce their own as the new year dawns. And so I think it exposes a weakness in the industry. It also exposes a weakness in the tech companies themselves, and that they're so focused on profitability, growth, and engagement that they're willing to kind of go light on those protective measures in order to protect investors. And I think that sort of balance between mental health, profitability, and growth needs to be addressed in the coming years, largely through legislation that up until now has failed to pull in or rein in the worst excesses of this industry.
And as you say, like, we're maybe going a little too slow when it comes to legislation. So I wonder if you think we're going to pick up the pace in 2026 and get to a more reasonable pace. And with that in mind, what should viewers be maybe concerned or excited about as we head into 2026 when it comes to tech?
I think it's inevitable that we will be picking up the pace here. I think the agenda in Ottawa is very clear. We've got to move, and so I'm expecting more announcements on that. We had a national cybersecurity strategy announced earlier this year, which was an important step in that evolution. We can expect more on artificial intelligence early in the new year, and that's certainly something I'm watching for. What I'm also watching for is that next big lift in artificial intelligence. We've been talking about chatbots, image generators, kind of AI-powered apps. We haven't really been talking a lot about agentic AI, the automation potential of artificial intelligence to rewrite the way businesses work, the way industries go to market. And so we have been hearing a lot about that in the past year. We're going to be seeing a lot of that actually hit the market in the new year. Meta, for example, just bought a company that specializes in agentic AI known as Manus, and they're going to be incorporating that into their platforms. Expect other companies to follow. This is going to be the significant trend to follow in the new year.
Okay, so I'm not sure if that's one of them, but you do have some key themes that you see playing out in 2026. You might have touched on some of them already, but what are some of those?
So certainly data centers are going to become, Canadian communities are already wrestling with this. They demand huge amounts of power, huge amounts of real estate, and they are necessary in order to power the AI economy. We are going to be seeing more of that kind of flashpoints in Canadian communities over the year. We are going to see this continued battle between the U.S. and China over AI models. DeepSeek absolutely roiled the markets when it released its R1 model earlier this year, kind of turned a lot of assumptions on the technology on its ear. You don't need to spend billions and spend years training your models and then powering them on the highest power hardware. And so as the year ends, DeepSeek continues to kind of push that agenda and really sort of, illustrate that China doesn't want to be left behind here, and they are going to continue to make noise as we move into 2026.
And Lindsay was speaking with technology analyst Carmi Levy. Our next guest says animal spirits are returning to the markets. We have more on what that means after the break. Before 2025, most people expected the policies of U.S. President Donald Trump to boost the U.S. dollar and keep American stocks on top, while trade wars would hurt global markets. Our next guest says we saw the opposite, with the dollar weakening and international stocks performing well. We spoke with Tyler Morty, CEO and CIO of Four Strong Global.
We obviously, of course, we saw a fairly damaging year in terms of tariffs. We've got the highest tariff rates since the 1930s. But I think where investors got caught flat-footed is they cling to these sort of simplistic cause and effect narratives, which is a political headline. So tariffs are obviously a terrible thing. But when you cling to those simplistic narratives, the cause and effect models, then it can really catch people off guard. So what we saw, Lindsay, was the big surprise for 2025 was the international markets staged a really strong comeback, and we've got a lot of reasons for that. But I think clients were pretty impressed with that.
It's been fascinating to see it kind of play out. Were there any countries or regions that stood out to you the most in terms of like a comeback almost?
Yeah, that's the thing. It was a true broadening bull market, like breadth right across the board. Leadership came from Europe, from Japan, even Latin America, places like that. We saw, if you go across the Atlantic to Europe, we saw European banks have a very strong year. European banks were up over 60% US dollars. Japan finally decisively broke above its 1989 highs, which was amazing. South Korea was one of the top performing markets, Lindsay. So we saw it right around the world, and I think it's important because this broad-based rally that we saw is signaling that we are likely seeing a leadership shift away from the United States at the exact time when most people don't think that was going to happen. So the U.S. market, going back to December 2024, if we're placing ourselves back in time again, at one point it was 67% of the MSCI All Country World Index. That still stands at a gaudy 65% here, but I think the key takeaway is we're no longer in an all-American bull market, and for the first time in many years, we're seeing this broad-based rally. You'd actually have to go back to prior to the global financial crisis in 2008 to see this sort of broad-based rally. So super encouraging right across the board.
I wonder, just to pick up on that, like you say, it seems as though the leadership is kind of shifting away from the United States. Is there any country or region that you see as in the forefront in terms of taking over the leadership, or is that still up for debate?
I think it's still up for debate. I mean, if you think about Europe, Europe's in a classic cyclical recovery. If you look back at the 2010s, I mean, and starting points matter. Nobody had anything good to say about Europe over the last few years here. It was sort of stuck in stagnation. It was a sclerotic block. There was, we had Brexit, we had all these types of things. And 2010 saw a pretty terrible time. We saw the Southern Europe region deleveraging, the property market was bust. We saw sort of self-imposed austerity in the north, Germany, France, et cetera, et cetera. So Europe seems to be in a sort of a classic cyclical recovery. Now we've seen stimulus, we've seen the European Central Bank drop rates by about 8 times here in the last 18 months. And so that would be more of a traditional business cycle. If you go to Asia, it's a little different because I think China is sort of the poster boy for that. When you look at China, what was the word that was most closely synonymous with China last year? It was that China is uninvestable. And of course, we saw a big real estate bust. We saw a technology crackdown. We saw a variety of different things, and just sort of a revulsion, if you will, towards China. And China now has outperformed the United States, and we're at market close here. So China has now outperformed the U.S. markets for 2 years in a row. So something's different is going on, Lindsay. And we've got sort of deeper macro forces at work here.
Interesting. You might have touched on this already because I genuinely don't know what this means, but you say animal spirits are returning to the international markets. What does that mean?
I think so. Animal spirits is the colorful word that John Maynard Keynes once used for when you see a risk cycle emerge, when people start to get excited about different asset classes and everything like that, and so you sort of get the just the exuberance and the the jealousy and the envy and all these feelings that sort of fuel a bull market. So the animal spirits are definitely coming back to Asia. I think if you look at China now, the AI fever, if you will, has now spread to not only to China but to Japan, to South Korea, to Taiwan, and so those animal spirits have sort of perked back up. And again, it's important to remember that we're coming off an extremely long period of underperformance for international markets. You'd have to go back to prior to the global financial crisis to see when those international markets actually outperform. So it's been a long, frustrating bear market for those who are bullish on these international markets. But we had a catalyst this year, Lindsay, which was the trade war, which sort of pushed all these countries into action.
Just very quickly in our last 30 seconds, for Canadians who may be looking to trade abroad and maybe haven't done so before, any quick tips for people who are maybe just looking to trade internationally?
Yeah, I mean, for our clients, I'll tell you what we're doing with our clients. I mean, we have had this asymmetric trade. Everybody's all in on the U.S., primarily on big tech. And a lot of things have to go right for that to materialize, and a lot of factors have to sort of unfold to meet those top valuations. So what we're recommending to our clients, what we're doing for our client portfolios is rotating, taking some profits away from the U.S. big cap tech and putting them into these international markets, which are what we think are in sort of year one of an unfolding bull market. And I would say most Canadian investors are very, very underexposed to these international markets, and we think it's just getting started, Lindsay.
And Lindsay was speaking with Tyler Morty, CEO and CIO of Four Strong Global. And some of the Wall Street's top strategists are still feeling bullish as we kick off 2026. That includes Citi, which put together its buy list for the new year. We'll take a look at that with John Ehrlichman right after the break. Well, some of Wall Street's top strategists are still feeling bullish as we kick off 2026. That includes Citi, which put together its buy list for the new year. BNN Bloomberg contributor John Ehrlichman has a story on our website about that. And he hosts, of course, the Investing Channel, Ticker Take, on YouTube. And he's here right now. John, Happy New Year to you.
You too, Roger. And this is that moment where everybody starts to share picks and strategy for the new year. And last time I was with you, we were talking about how all the top strategists on Wall Street, because Bloomberg surveyed all of them, they're all predicting a higher S&P 500 by the end of the year, which immediately invites criticism. People saying, oh, they're just lemmings, blah, blah, blah. So it's always helpful to kind of dive a bit deeper into what individual strategists are saying. And we had a good conversation with Drew Pettit from Citi, who made the point that, yes, we are in a bull market and stocks have had a big run. The question becomes, should you transition out of some of those stocks just because? The guest before the break who spoke to Lindsay was talking about taking profits out of some of the big U.S. stocks and moving them international. If you were still going to keep that money, let's say in North America, if you moved it to the middle of the market because you thought valuations were better, Drew's just making the point that what if that means that you just end up getting mediocre performance? So his view is to make money in a bull market, you have to keep taking risk. He's sticking with growth, but selective growth. One bucket is companies that get great returns on the money they invest, and the other would be more cyclical growth that could benefit if the economy improves.
And where do we stand? What are we looking at for the companies that they're liking?
Right. So he went through in our Ticker Take YouTube video 7 specific stocks, and we have them all on our website. And they would include on the growth side companies like NVIDIA, but it would also include names like Boston Scientific. This is a company that's known for its innovation with healthcare technology. And so when they spend, generally, that benefits them. And then also cybersecurity threats, right? These are very much a daily reality now. CrowdStrike, which is now about a year and a half removed from that outage, which really dented their business. He looks at that company and he says there's great growth opportunities with that example too, in that sort of traditional tech bucket. Now, on the cyclical side, if you were to see improvements, let's say, in real estate, he looks at a company like CoStar, which longer term has been a great performer in the market, more choppy in the short term, but a company that has a lock on a lot of real estate related data. And then a company like Regal Rexnord would be another that he flagged, which, you wouldn't necessarily know what they make, but the parts and things that they make that go into larger machines and factories, you would definitely know more about that, and the kind of company that might benefit from sort of a cyclical boom, if you will.
And going back, we'll start, say, with Boston Scientific. Any concerns about headwinds for it? Did they talk about?
Well, absolutely. I mean, for any company, I think that's the big question. The main strategist sort of commentary, when I go back to sort of those lemmings that are all sort of in the camp of we're going to see a higher S&P 500 this year, I think it comes down to earnings. If companies can deliver on the profit side, that's going to justify a willingness on the part of investors to put money into companies. Valuations generally go up if profits are going up. And I think, on the healthcare side of things, that would most definitely require the economy to be in reasonably good shape. But, there are a lot of companies that are starting to fire on a lot more cylinders than maybe the market is giving them credit for. I mean, NVIDIA, which is one of the other companies he talked about, I mean, we've exhausted the story on NVIDIA, but I will come back to the fact that every year their profit story is improving, and they're expected to see massive profit growth over the next 5 years. Does that justify a huge flood of money going into the stock? I guess we'll find out. Uber is another one. You know, in the case of Uber, you're talking about a company that spent a lot of years spending. Now they're getting the returns on that spending. So it'll be an interesting year to watch for sure.
They talk at all about emotion because we've seen 3 really good years. There's talk this year maybe the return is going to be 9-10%, more of a normal year. Any concerns about investors sort of hitting the panic button a little?
I think absolutely. You know, he got into the psychology that people almost feel that they shouldn't be able to generate more after they've generated so much. Like that uncomfortable feeling of if a stock has already gone up double-digit percentage, whatever that might be, that it's sort of human nature to say, you know, do I want to take money off the table? And I guess that really comes down at the end of the day to where people think we are in this bull market. If you're a believer that we've just gotten way too far ahead of our skis here, then there is a great case to be made for shifting away from some of these companies. But you know, even in the Canadian stock market, if we think about what's happened over the last year, right? Do people think the rally in gold is over just because gold has been in a bull market? That'll be a big question for people to ask with things like gold stocks, which already had a big year in 2025.
Okay, we have to wrap it up there, John, but thanks as always for joining us. All the best for 2026.
Thanks, Roger.
John,
You too.
John Ehrlichman is there. You can find that story on our BNN website. Coming up, we're reviewing a Canadian economic outlook into the new year with our next guest. That's after the break. Welcome to the second hour of The Open. Let's take a look at some of the stories we are following in the BNN Bloomberg newsroom. Shares of Denison Mines are surging today. You can see it's up by 10.7% right now. The Canadian Uranium Company says it's ready to begin building a uranium mine in Saskatchewan once it receives final government approvals. The project is poised to begin producing uranium by mid-2028 and is set to become Canada's first major new uranium mine since Cigar Lake. Denison warns, however, that total costs for the project are now estimated at 20% higher than planned. That's about $500 million is where they stand now for costs. U.S. President Donald Trump has pushed back a tariff on some imported goods. He's pushed it back a year. The move will delay a 30% tariff on upholstered furniture and a 50% levy on kitchen cabinets and vanities. Trump says the move is due to ongoing trade talks. A 25% tariff imposed in September will remain. Now, the price of aluminum climbed above $3,000 U.S. a ton for the first time in more than 3 years. The jump is due to a cap on Chinese smelting capacity as well as constraints to European production due to higher electricity prices. Both have chipped away at global inventories. The demand outlook from the construction and renewable sectors also contributing factors. Taking a look at the markets, a bit of a bounce back today after a poor finish in the final week of 2025. No real Santa Claus rally, although I guess if we get a couple over the next 2 days, it might count, might be a positive in the end. But right now we can look and see TSX up by about a half a point, little under 0.47%. And 2025, still a good year. It was up 28.84%. South of the border, and it's all green down there, although the Dow just about a wash right now, but S&P 500 up by 0.67% as it pushes in on 6,900. And the NASDAQ up by 1.3% right now. Shifting to oil, and that struggle continues for it. It's off again. WTI by 1.25%. For the last year, it's down almost 21%. Gold, of course, going the other way. And it's rallying again today. Silver is much the same, but gold's up 65% in that last year, and you can see it's up today by 0.53%, over 4,300 an ounce. And last but not least, the dollar. Struggling a little bit today to start the new year. It's off by 0.16%. All right, we've entered a new year, so we're looking forward to what to expect for Canada's markets and the economy. Our next guest thinks this year will be one of resilience and opportunity, with GDP expected to grow and inflation contained. Here to expand on that is Ashish Dewan, Senior Investment Strategist at Vanguard Canada. Ashish, thank you very much for joining us.
Happy New Year, Roger.
And Happy New Year to you as well. Thank you. You're an optimist for the start of the year, GDP especially. What's fueling that optimism?
Well, we actually think that the AI is going to give the economy a boost. But on the market side, we actually feel that the markets might be pricing in too much perfection. So, in the near term, actually, we think the growth is really going to come from the investment spending side. And that's really going to boost GDP growth in the U.S. We also believe that there are going to be other influential factors shaping up in 2026. On the demand side, we have monetary policy. We also have on the demand and supply side, fiscal policy, and then there's what we actually categorize as mega trends, and these are, things like globalization, demographics, debt, and AI. Slow-moving supply side factors, which have a profound impact actually on the economy. So given all that, we actually think that near term there's going to be growth from investment spending in the United States, and that's going to also benefit Canada. But in the longer term, actually, once AI does diffuse across various sectors, we'll actually see more productivity gains. There are obviously risks in the market. We see that valuations are stretched. And risk is actually concentrated in only a few firms. We see that the top 10 firms in actually the S&P 500 are now 40% of the index. And so if AI actually disappoints, some of these stretched valuations could actually unwind, and we could see AI sort of plateauing at a lower plane. So we do see opportunities, and we see opportunities in U.S. value, developed ex-U.S. stocks, and also in fixed income, particularly Canadian credit.
All right, lots of questions. First up, the investment spending. What makes you think that's where the money's going?
Well, we've seen that the AI hyperscalers have actually committed $2.1 trillion into 2027. So we really don't have a reason to doubt them. We think they'll come through on their commitments. And we've actually charted out, past build-out cycles, major capital cycles, and we do feel that this one is similar to some of the past cycles. We do think we're in the early stages of the cycle. So the key question is this big or is this small? And what we have seen, looking at share of GDP from past build-outs, is that this cycle is going to be similar to past cycles. But there's still a lot of range of outcomes, and we actually think we are in year 3 of an 8-year investment build-out. And the past cycles I'm talking about are, the post-World War II autos. You have the 70s and 80s oil exploration build-out. So the key message is really we're only 20% to 40% through in terms of the cycle, and there's still significant investments ahead.
Now, you didn't mention the .com though. What makes you confident that it's not that?
Well, I think comparing it to .com, for example, that was in the late 1990s, and valuations are stretched at this point in time. But a lot of these companies are actually fairly good in terms of having good free cash flow. They also have strong balance sheet. We think that actually. Based on our fair value, if you look at things like the Vanguard Capital Markets model, which looks at interest rates, the neutral rates, the long-term rate of inflation, We actually think that the market is a little bit overvalued right now. But if you look at kind of some of the consensus estimates of earnings growth, which are about 10 to 15%, and if those do actually materialize, we do think that the market could be fairly valued. But this really assumes that AI delivers perfectly and there's very little margin for safety.
Okay. And with AI, you say longer term AI is going to start kicking in. Is it that companies are now adapting this full force?
Well, so we're still, as I mentioned, in the early stages, Roger. So, it's going to take some time. So our view is really AI is going to diffuse across different sectors. So, the first stage of a cycle like this, it's usually the builders that benefit. And we see companies such as, the Mag 7 companies really benefiting. But really, it's that we're in phase 2 right now. And it's really that, technology is going to diffuse into different sectors. Hospitals are going to use it to improve productivity, for example. You'll see it disseminate across the manufacturing sector, the educational sector, and that's really a strong boost to what we consider sectors outside of where the technology originates, so outside of U.S. growth, and that's why we're more optimistic about developed ex-U.S. Equities as well as U.S. value stocks.
Okay, we're going to have to wrap it up there, Ashish, but thank you for joining us, and again, Happy New Year to you.
Happy New Year, Roger.
Ashish Dewan is a senior investment strategist at Vanguard Canada. Coming up, we'll dive into investors' outlooks on U.S. and Canadian markets for 2026. Time to look ahead at what we can expect for the U.S. and Canadian markets in 2026. For more on this and what kind of an outlook investors have, we were joined by Brianne Gardner, Senior Wealth Manager at Velocity Investment Partners, Raymond James.
The big question is really whether the U.S. or Canada leads. And our view is that we see the S&P 500 likely having a little bit of an edge, but with a few important caveats, I'd say. Most street forecasts right now, analysts are predicting the index climbing again this year. We're seeing some targets across the street as high as 7,500 to 8,000, driven by earnings and the tech sector leadership continuing to pull it higher. I think, base case, we do expect 8 to 10% from the S&P 500 right in line with its long-term kind of average return. Bull case, you see a bit of a melt up and we see another double-digit year. I think the U.S. economy is entering 2026 still in really great shape, right? We've seen GDP and retail sales are still showing no signs of a slowdown yet, and commodities have had one of the best runs in decades, and we really think it will continue to be one of the leaders again this year. So that said, I still prefer a diversified portfolio that can generate, alpha by tactically positioning, so that if a sector volatility hits, and we do expect 2026 to be quite a volatile year, especially with midterms coming up, the portfolios that, will see a little bit less of a downside. So we are continuing to expand across different sectors and geographically as well.
And we've been spoiled the last 3 years, double-digit plus returns. Could that be a factor? People expecting something like that again? Could that play into it? Emotion?
Yeah, I think one thing that we're watching that's continuing to drive markets higher is really earnings, right? In the U.S., earnings are still doing the heavy lifting. The S&P 500 profit margins are expected to be near 14% again in 2026. So again, still double-digit growth out of a lot of these large cap companies, and that's well above long-term averages. And so when we're seeing that type of profit margins well above that, that keeps the earnings story intact. Revenue and earnings should see double-digit year over year. In Canada, the TSX can still do well, but leadership likely to shift, and the Canadian long-term returns are typically slightly lower than in the U.S., which is expected to continue to see that this year as well. There will be a few, I think, areas to make money. And while commodity prices will help the materials sector, demand for quality, income should support dividend payers and diversification rather than kind of chasing that rapid, growth story still. So I think volatility is, again, going to be something we expect more this year, a little bit more muted going through 2025. We only had that one double-digit correction mainly. So not a crisis level volatility, but I do think more frequent rotations between sectors, style, and regions. And as a market reacts to these earnings numbers that are coming out, interest rates continuing to come down and trade-related influences on corporate America. Again, I think that we will see a strong year through 2026, but could be a little bit challenging to start.
All right, John, you want to jump in?
Yeah. Hey, Brianne, Happy New Year. You got to we have quite a winter up here. You got to get up here, get on the hills with us.
Hi, John. Happy New Year to you.
Roger and I were chatting a lot about the tech stocks already, and I'm sort of curious, where are you playing? I mean, everybody's sort of in tech, but I think the big thing is, what parts of it. So what are you looking at both here and in the U.S. and within the tech sector?
Yeah, I think from a sector perspective, we did see tech, continuously lead 2025 and have a strong, earnings and returns for this past year. But I don't think it's going to be the tech sector alone that is going to continue to carry the markets. With, historically, the tech sector, it does tend to be one of the strongest ones. And there's usually more help from communications, industrials, consumer discretionary, so to say. In Canada, 70% of the performance of the TSX came solely by materials and financials. And those two will likely continue to be kind of the top half again. So yes, I still think earnings are projected to be in the tech sector double-digit growth. And can these large cap names continue to do well? I think, again, the AI story, if we're specifically going in there, I think it's going to be a little bit more broadening out as we're getting more companies who are getting into the space, developing more, and not just on the chip story, but more on, how is this going to be sustainable in the long run, and what sectors are going to continue to benefit from that. So that's certainly all things that we are looking at in the tech space. And I think, with that in mind, we still like U.S. tech names given corporate investments and productivity gains. Utilities, especially tied to rising power demand, is going to be a big one. And I think, too, healthcare, has been an underlying story where valuations are attractive and earnings have still remained resilient in that space. Okay. So I do think we're going to start seeing utilities kind of pick up there, too.
Brianne Gardner, that was Senior Wealth Manager at Velocity Investment Partners, Raymond James. Coming up, tech stocks like NVIDIA are rallying today, but is there reason for caution? We'll get insight from one veteran investor right after the break. Well, tech stocks soared in 2025 on the hopes of AI, but cracks are starting to show from NVIDIA's dominance to Oracle's warning signs. We were forced to ask ourselves if the AI trade is entering a new phase. For more about that, we spoke with John Zechner, chair and founder of J. Zechner Associates.
If NVIDIA is the coal mine of artificial intelligence, is Oracle the canary in it? And that's sort of what I want, because that's really been the whistleblower on some of the valuations and the stories in the past quarter in particular. It's almost like we're talking about an interest rates as well, Roger. I mean, there's a lot at stake here, and it sort of could go either way. We know technology will continue to grow. We know it's an increasing part of the economy. AI will ultimately, is going to change productivity and improve the economy. Apparently massively, and we've seen all the indications from that. My issue is a little bit you're paying for so much of it today, and anytime you pay for something that has not happened yet, at an accelerated rate or a higher rate, you have inflated risk effectively, because if it happens, well, it's happened and we were paying for it already, so it doesn't go much higher. If it doesn't happen, there's a lot of downside to it. And that's why I get a little queasy about, the valuations and just the bullishness around the story. And like I say, people say it's not the same as 2000 because they're better companies, they're more resilient and all of that. Absolutely true. But I'm starting to see a few things that remind me a little of 2000-ish. I mean, the one is this Oracle's, what kept Oracle going. Like I say, that's why the canary in the coal mine really started lifting in September to those massive gains was, they are becoming the sort of the AI cloud in their data centers. And that's sort of their, and they had sort of great contracts from OpenAI, but they're not really revenue contracts. They're not backlog. They're what they call RPOs, or remaining performance obligations, which is a sort of an indication or almost a promise that at some point we will generate these revenues. And they're sort of you can't put them on the balance sheet, but they're putting them in the financial statements and the releases. And that's what's driving a lot of the growth. And, that reminds me a little of, remember back in 2000, this is the eyeballs test and things like that. I thought you need something real. I mean, the combined spending of the Mag 7 last year, or the hyperscalers, with basically $400 billion on AI infrastructure and AI rollout. You start doing it over multiple years, you've got trillions of dollars invested. To get any sort of normalized return on equity or return on investment on this amount, you need hundreds of billions of dollars worth of improvements in productivity. And, maybe it'll come. And I listen to both sides of the arguments. Roger, I haven't seen it yet. A little from Missouri, a little of a skeptical on that. Like, I started my business in the 90s, the early 90s, and it was the age of the internet. And at that point, I mean, it had a massive impact on how, when it's how you do spreadsheets, you started networking, you could sort of relate that within your client base, within, who you could talk to. And then there was a huge improvement in efficiency. I mean, ChatGPT and Gemini, I find them, interesting, and I use them, but I have yet to see that massive productivity increase. And others tell me, no, it's coming and it's going to be huge. But we're paying for it already.
What might be some triggers for you in 2026 that would really have you thinking?
Well, I just think maybe a slowdown by some of the hyperscalers in their spending might indicate that maybe demand isn't exactly where they expected it to be, or not a continual increase in that. That would be a bit of a headwind. But for the technology sector, general, Roger, my way to play is, why don't we play the stuff that is assuming the negative impact of AI? And, it's gotten overly beaten up. I mean, the software companies, everyone assumes that AI is going to bypass the need for application software. I don't think companies are going to restructure, their entire back rooms and their entire application systems and everything else, on a whim or immediately. And yet these stocks are sort of being priced, you'll get, Salesforce and Adobe and Workday and ServiceNow and all of this. They've been, stocks have been, put under a lot of pressure. Look at Constellation Software up here. I mean, I'd rather kick the tires on those at lower valuations than to chase some of the, the high flyers like the Oracles and the Palantirs of the world that are really, I think, have all the optimism of AI built into them already.
But isn't there dangers, though, with looking at the ones you're looking at, that if AI does come true, they actually will be obsolete almost?
Absolutely, but it's almost a counter of the argument that I use I hate paying up for something that hasn't happened yet on the expectation that it will. On the same thing, when stocks get punished for a negative outcome that may or may not happen. Well, what's your downside if it happens the way we're expecting? Well, the stock's already trading at, look at Adobe trading at, 15 times forward earnings. I mean, there's probably not that much downside risk from that. So, I'd rather, but that's more I sort of more of a value orientation in that regard. So that's what I tend to do is, look for some of the laggards where there's too much pessimism about, the negative impact of AI on these companies. But, on the other side, there's the, healthcare will be a beneficiary, telecom will be a beneficiary. We see lots of it. I just want to see more concrete examples of it. And I think the market may get impatient at a point that, there's a lot of talk, but let's deliver something.
All right. That was John Zechner. A look back now coming up. A look back and a look ahead. We're doing a lot of that today on how tariffs affect the Canadian economy. That's next. Oil is picking up where it left off in 2025. It is down again today, 1.3% almost at 56.68 for WTI. It has been seeing some 5-year lows over the last month. Now that supply, there are concerns that a supply surplus will offset geopolitical risk to production in several OPEC plus nations. Now OPEC is leaning toward caution, with key members expected to reaffirm a decision to pause supply increases during the first quarter. The International Energy Agency has forecast a glut of about 3.8 million barrels a day for this year. Tesla reported a bigger than expected drop in fourth quarter deliveries and also posted a second straight decline in annual sales. Sales were off nearly 9% compared to the year before, while deliveries fell 16%, missing Wall Street estimates. The EV maker has been struggling to boost demand for its vehicles following the withdrawal of tax incentives. Investors are also noting concern about the automaker's 2026 sales targets. Shares of Sable Offshore are surging after it received the green light to restart a controversial pipeline. Sable can now begin pumping oil from its 3 platforms off the coast of Santa Barbara, California, after a federal court ruled against environmental groups challenging it. It's the latest win for the oil operation, which has been battered by lawsuits and regulatory scrutiny since ExxonMobil handed over the reins 10 years after the unit was shut down following a massive oil spill. Taking a look at the markets, a bounce back for today. Well, it's calming down a little bit after that negative end to the year last year. You can see the TSX up by 0.23%, the S&P 500 almost a wash right now, and the Nasdaq is giving back some of its early gains to start the day. It's up by about 0.18%. Well, one word that might define 2025 would be tariffs. CTV's Michael Couture has this report on the threats and taunts over tariffs that took over 2025 and triggered a trade war.
We don't need their cars, and we don't need the other products. We don't need their milk.
It was the opening salvo in the year-long trade war. Threatening to take Canada by economic force, President Donald Trump floated punishing tariffs on his first day in office.
We're thinking in terms of 25% on Mexico and Canada because they're allowing vast numbers of people. Canada's a very bad abuser also. Vast numbers of people to come in and fentanyl to come in.
They applied to all goods not covered by CUSMA. The day they took effect, Canada hit back.
Tonight, I am announcing Canada will be responding to the U.S. trade action with 25% tariffs against $155 billion worth of American goods.
Provinces also joined in the fight, removing American alcohol from liquor stores and threatening to cut off energy exports to the U.S.
The next Prime Minister of Canada, Mark Carney.
After campaigning on going elbows up in the face of Trump's tariffs, Prime Minister Mark Carney went to D.C. a week after the election, looking to reset the relationship. In that Oval Office meeting, the Prime Minister did push back on talk of Canada becoming the 51st state.
As you know from real estate, there are some places that are never for sale. And having met with the owners of Canada over the course of the campaign last several months, it's not for sale, won't be for sale.
The two met again at the G7 in Kananaskis, where they reportedly set a 30-day timeline to get a deal done. But the pathway remained the problem.
I've always been a tariff. It's simple, it's easy, it's precise, and it just goes very quickly. And I think Mark has a more complex idea, but also very good.
Over the summer, Canada responded to Trump's complaint about the digital services tax by removing it. While talks continued, so did the threats and uncertainty for businesses.
You guys are about as dumb as a bag of hammers for doing this.
And when the company that makes Crown Royal whiskey moved work at a bottling plant from Ontario to the U.S., Premier Ford didn't hold back.
So this is what I think about Crown Royal. That's what they could do. And I think everyone else should do the same thing.
With trade talks slowing, another Oval Office meeting took place in October, where Trump spoke glowingly of Carney and Canada.
I would think he's more popular now. He's a good man. He does a great job, but he's a tough negotiator.
So then what's holding things up? If he's a great man and you want to do a deal with Canada, why aren't you?
Because I want to be a great man, too.
But that laughter would fade after Ontario released an anti-tariff ad in the U.S., using a speech by former President Ronald Reagan. Trump called it a hostile act, while his ambassador to Canada described it as election interference.
A foreign government running political ads in the United States during election season is unprecedented.
Carney would apologize to Trump at the APEC summit, and weeks later, the prime minister downplayed how much or little he communicates with Trump.
Who cares? I mean, it's a detail. It's a detail. I spoke to him. I'll speak to him again when it matters.
Those words got this response from Conservative leader Pierre Poilievre.
All of us on this side of the House care about the communities that are being emptied out in our forestry, the steel workers in Hamilton who don't have jobs to pay their mortgages. We care.
Carney, Trump, and Sheinbaum had a 45-minute meeting after the FIFA World Cup draw. In the same week that Trump mused about letting CUSMA expire, he also agreed to keep working on the trade agreement.
Canada makes a lot of things that we don't need because we make them also. But we'll work it out.
The following week, Canada's envoy to D.C. announced she would be stepping down in the new year, saying it was time.
Our discussions with the United States with the CUSMA review, the Canada-U.S.-Mexico Trade Agreement review, that's going to start up in the new year. And I think it's important that we have someone in place that is going to be here through the conclusion of those discussions.
The formal joint review of CUSMA is scheduled for July 1st, 2026, setting up what could be another year of turmoil with our largest trading partner. Mike Lecouteur, CTV News, Ottawa.
Coming up, legendary investor and Berkshire Hathaway CEO Warren Buffett begins his retirement today. We'll take a look at his legacy after the break. Legendary investor and now former Berkshire Hathaway CEO Warren Buffett begins his retirement today. Here's how the Oracle of Omaha changed investing forever and what's next for the company he built.
If investors had a Hall of Fame, Warren Buffett would occupy his own wing.
People from all over the planet look up to him, read his biography, hop on a plane to go see him talk.
He took a failing textile mill and turned it into a trillion-dollar conglomerate. It has insurance companies, Dairy Queen, railroads, and energy businesses.
For decades, Buffett's investment savvy has led Berkshire Hathaway to beat benchmarks.
One of the biggest asset managers today, which is Vanguard, the entire philosophy is no one's really going to be able to beat the market, so you might as well not even try. Well, okay, no one besides Warren Buffett.
If you look at the total returns, Berkshire blows the S&P 500 away.
The legendary investor Warren Buffett.
So when the 95-year-old announced he would retire at the end of 2025,
Greg should become the chief executive officer of the company.
It marked the end of an era at Berkshire Hathaway.
Greg Abel led Berkshire's energy business for so many years. But it is tricky. Warren Buffett has not only been a very good investor, but he's also pretty charismatic.
He won't be writing the annual letter next February. This is a big change because Buffett fans have been poring over that letter over the years because it's full of witticisms, investment advice, pearls of wisdom. There's also the fact that he's not going to be taking Q&A at the annual meeting next May in Omaha.
Morning. Welcome to Berkshire Hathaway.
He was talking for 4 to 5 hours every year and taking questions from people that follow him all over the planet. That is going to be a big change because Buffett's personality is unmatched in the investment world.
Sorry, we are having some technical issues with that about the Oracle of Omaha. Of course, we're talking about Warren Buffett, who began his retirement today, although he is still chair of the board for Berkshire Hathaway. We'll have more coming up on what investors can expect and what they think Canada will see when it comes to developments in the economy, especially with new collaborations with Asian and Middle Eastern countries. More on that after the break. What can we expect for the U.S. and Canadian markets in 2026? We were joined earlier by Michael DeHall, Senior Portfolio Manager at DeHall Investment Partners, Raymond James.
Some of the policies that they're putting into place could provide some tailwinds to our Canadian economy and to our Canadian equity market. Areas that we do like are industrials, as well as other types of financials sectors within the Canadian economy. But we do think that the Carney government will have some great policies in place, more of the physical side. The heavy lifting has been done by the Bank of Canada, so we do not expect any changes to interest rates in 2026 in terms of rate cuts, but we do think that now the fiscal policy should do its job.
And start to kick in. What else would you like to see from the Carney government?
Continued spending, more spending on infrastructure, on construction, to really beef up our economy here in Canada, as well as trade partnerships outside of the U.S. I know Carney has been going to other parts of the world, Middle East, Europe, Asia, to strengthen those relationships. So what I'd like to see in 2026 and beyond are more partnerships with other countries outside of the U.S. and really strengthen those relationships and helping our exports go across borders.
Now, I think a lot of people were expecting these magical deals to be signed all in the first 3 months after he made these announcements that we're looking outside the U.S. What kind of possible headwinds might we see for the Canadian economy?
The big headwind is obviously the U.S.-Canadian trade relationship, right? We do have the USMCA agreement coming due, I believe it's August of 2026. So we could see some volatility ahead of those talks, and if anything, if there is any agreements prior to that date, but that could be a headwind. Another headwind to our Canadian economy could be a job market. We are seeing a bit fragility in our job market, although the last 3 months, the unemployment rate has come down slightly better than expected, primarily due to part-time jobs. But the job market is something that we are looking at, whether unemployment rate goes higher and the impact on immigration. Obviously, the government has reduced the number of immigrants to Canada, and that could have an impact to our economy as well.
And it does seem like a lot of companies have adjusted or adapted to the tariffs, and they didn't have as much of an impact. But of course, if CUSMA goes by the wayside, as Trump has hinted that could happen, that would have a huge impact, though, wouldn't it?
Absolutely. And that's the big the question mark is the uncertainty around the trade talks, right? So if that does go a bit sour, that could have a headwind to our economy, and so that's something that we are definitely looking out for. But we do think that our government, Carney, and the party will have our best interest for the Canadian consumers to kind of alleviate any negative impacts to those discussions or to that agreement that could come forth.
Okay, let's talk a little bit about the U.S. economy. What are you seeing? Unemployment was down there as well. It seems to have defied expectations, hasn't it?
Absolutely. We had such a resilient U.S. economy in 2025. After the Liberation Day of April, many people thought that the U.S. economy was going to go and, derail. And however, the consumer, the U.S. consumer, once again proved resilient. And GDP growth in the U.S., I believe, will probably come for the full year higher than expected. And we do think that continues. We think that the U.S. resiliency continues in 2026. This year, we'll probably see more tailwinds on the AI front. We're looking at companies that are benefiting from AI, from productivity, from efficiencies on adopting AI. So we do think that, in 26, the U.S. economy continues to march higher, obviously at a slower pace for the last 2 years. But we do think that we will probably get another robust year in the U.S. Economy, and we'll probably get another good year in the U.S. markets. We'll probably get more volatility this year than we had last year, but with some of the, the tax cuts that the Trump administration is implementing, deregulation, as well as the Fed continues to ease throughout the year in 2026, that can all provide very fruitful for the U.S. stock market.
And you mentioned about AI, and companies are starting to incorporate it now. Are we starting to see actual figures on savings and or potential savings with it?
Yeah, we're still in early days. A lot of CFOs, CEOs on their earnings reports, their earning calls, are looking at AI, how they're adopting it, how they're increasing their margins, improving their gross margins using AI. So we are still early days of AI adoption for the beneficiaries, but we do think over the next several quarters, it will get better as more and more companies adopt AI in terms of improving efficiencies. And again, that would go right to the bottom line, improving gross margins, which in turn helps stock prices.
Okay, I just want to bring it back to Canada for a sec. Mortgages for 2026. It's always something everybody's talking about. The housing industry, the housing market for Canadians is a big deal. What are you seeing there?
So that is a potential headwind. We do have a number of mortgages that are renewing in 2026. Remember, these are the so-called COVID mortgages that people got 5 years ago, right? So that would be something that we are looking at during the last the big Canadian bank earnings season that we had last month. Banks are increasing their PCLs, putting some money aside for potential loan loss provisions if consumers are unable to renew their mortgages or have difficulties with their mortgages with a higher rate. But that's something that we are definitely looking at. It is a topic of concern in 2026, the housing market.
That was Michael Dayhall, Senior Portfolio Manager at Dayhall Investment Partners at Raymond James. Well, 2025 came with a lot of political change. It started with Prime Minister Justin Trudeau resigning and ended with 2 MPs crossing the floor. All of this playing out while Canada-U.S. relations soured, bringing trade, tariffs, and Trump to the forefront of many decisions. CTV's Annie Bergeron-Oliver reminds us what happened in 2025 in politics.
Just days into 2025, the winds of change were blowing strong as Prime Minister Justin Trudeau announced his tenure was coming to an end.
This country deserves a real choice in the next election, and it has become clear to me that if I'm having to fight internal battles, I cannot be the best option in that election.
The election wouldn't happen until the spring, but Trudeau's plunging popularity with Conservative premiers, his caucus, and eventually the U.S. president had become insurmountable.
Justin Trudeau, nice guy. I think he's a very good guy. I call him Governor Trudeau. He should be governor.
For months, their troubled relationship and Trump's calls for Canada to become the 51st state dominated the political agenda.
Oh, say, can you see?
And even bled into the sports world, where the U.S. anthem was repeatedly booed. The tense tariff war and strained Canada-U.S. relationship, becoming the focus of the 2-month-long Liberal leadership race.
Our neighbors want to take us. No way.
From the start, the former Bank of Canada governor was the front-runner, and in the end,
the next Prime Minister of Canada,
Mark Carney easily won, defeating former cabinet ministers Chrystia Freeland and Karina Gould.
We didn't ask for this fight, but Canadians are always ready when someone else drops the gloves.
The hockey metaphors continued into the federal election campaign that Mark Carney called.
I'm asking for your vote so we can be Canada Strong.
But Canada Strong wasn't the only slogan that took hold.
Elbows up. Elbows up.
This ad with comedian Mike Myers caught the attention of Canadians cementing elbows up.
Elbows up.
As Carney's go-to phrase.
Elbows up.
The 5-week campaign focused almost exclusively on affordability, Trump, and Canadian sovereignty.
Justin Trudeau and Mark Carney and the Liberals have made Canada's economy weak. They are not strong enough to stand up to Donald Trump.
At the start, the Conservatives, led by Pierre Poilievre, were poised to form government. But by the end,
The night before the election, how many of you voted already?
Canadians voted for a slim Liberal victory, 169 seats, including the riding of Carleton that was previously held by Pierre Poilievre. The Conservatives won 144 ridings. The NDP just 7. Its leader, Jagmeet Singh, losing his seat and his political career.
We may lose sometimes, and those losses hurt, it's tough. But we are only defeated if we stop fighting.
Do you think there should be a leadership review?
The election results triggered questions about whether the Conservatives, who lost a major lead, needed a new leader.
Are you worried about a challenge to your leadership, Mr. Poilievre?
No.
Those leadership questions faded slightly over the summer after Poilievre won an Alberta by-election and Carney was accused of dropping his elbows or caving to Trump by repealing some retaliatory tariffs against U.S. products.
His elbows have mysteriously gone missing.
The elbows down saying has stuck around among critics who feel Carney isn't standing up to Trump. One MP who likely disagrees,
A good day for Canada.
Former Conservative MP Chris D'Entremont. The Nova Scotia MP crossed the floor to the Liberals in November, just ahead of a crucial vote on the budget and its $78 billion deficit.
I wasn't feeling that I was aligned with the ideals of what the leader of the opposition had been talking about.
Let's give a warm welcome to our newest member of the Liberal Party.
And he wasn't the only Conservative who felt that way. The night of the Liberals' holiday party, Markham's Michael Ma revealed he was crossing the floor.
Wow, such a big welcome.
Bringing the Liberals one seat shy of a majority government. But it wasn't all good news for the Liberals this year. The environmentalist Stephen Guilbeault resigned from cabinet after Carney and Alberta Premier Danielle Smith announced plans to build a pipeline to northern British Columbia.
Very pleased that the Prime Minister has heard our concerns and responded to them.
Questions about whether a pipeline are the right move for Canada now are expected to dominate the political landscape in 2026. And already, some pundits are speculating that an election call could come next year. Annie Bergeron-Oliver, CTV News, Ottawa.
All right, let's see how the markets are looking right now. We'll start with Bay Street first. And it's up, which is nice to see after that rough finish to the year. You can see it's up about 0.33%, nowhere near the record high we saw it hit late last year, where it was 32,000, just over 32,000, almost 32,100. Looking at maybe some of the movers just in on the high end today, we're looking at Bitfarms Canada. And we'll go to Denison Mines. It's having a good day right now, too. It is up 12.64% on that news. It's starting a new mine. So it is having a nice little bounce right now, and some other ones we're seeing moving right now. Who else do we have that we're going to pull up? We got Capstone again. Capstone Copper. It is off by 1.27%, dealing with a strike at its mine down in Chile, and that is hampering it a little bit right now. They say they're ready to negotiate, but right now one of the unions down there is on strike, which could cut production down to about 30%. So we'll see what happens with that. And going south of the border now, and you can see everybody's still in the green, but it's backed off a little bit. The NASDAQ was up by more than 1% to start the day, but now, as you can see, it's only up by about 1/10. And the Dow Jones, much the same, and S&P 500, all of them in similar territory, up about 1/10 of a point. Some of the movers, though, Wayfair is one of them. This after U.S. President Donald Trump announced that he was delaying a tariff increase on upholstered furniture, kitchen cabinets, and vanities. And so Wayfair reacted to that, up by 5%. And Sable Offshore, let's get that one in. It is just surging right now. It's up 20% after getting the green light to restart a controversial pipeline. Sable can now begin pumping oil from its 3 platforms off the coast of Santa Barbara, California, after a court rejected a bid by environmental groups. Well, that wraps up this edition of The Open. Morning markets are coming up next.